We are live. All right. Hi, everyone. Welcome to Let's Talk Markets. I'm your host, Dave Lauer, and I'm really excited today to welcome Charlie Dolan and Dan Labovitz, the co-founders of the Green Impact Exchange. I've known Charlie and Dan for many years now, and we've worked together in different capacities, and we always enjoy talking markets and market structure. So welcome, guys, and thanks for jumping on this stream with us today.
Yeah, thanks,
Thanks
Dave.
for having us. Yeah.
Good to see you.
Yeah, you too. So just a quick bit of background here. Dan is the former head of regulatory policy at the New York Stock Exchange. Charlie is the former CEO of Kellogg Capital Markets. He was a former executive floor governor at the New York Stock Exchange, and he was a trustee on the New Jersey Investment Council and a member of its ESG investment committee. So these guys have been in markets for a while. They've seen a whole lot of stuff from, I think, a really interesting perspective. And that, before we get into the Green Impact Exchange, which I love what you guys are doing with that. I love the idea behind it and the private market solution to that it addresses. And I'm both an advisor to the exchange, and I wrote a comment letter in favor of it. And we'll get into the SEC application process for exchanges in a bit. But before we get into all that, I'd like you guys to take us back. Talk about your careers and working at the New York Stock Exchange. Even before the advent or the sort of overwhelming takeover of electronic trading. Like what were markets like before all of this?
I'm going to let Charlie start on that one, but I'm just going to say that I used to be Charlie's regulator, so I'm going to be watching what he says very carefully.
Yeah, I actually hated this guy, but now we work together in building a new exchange. It's kind of crazy. Well, I guess I would start, Dave, by saying I graduated from college back in '86. I guess I wasn't too smart. I didn't realize there was a crash in '87. And I grew up in New Jersey. I had a brother who was working down on the floor of the exchange, so I decided to follow him down there. I started as a runner, running tickets around, which meant, orders would come from upstairs, a trading desk, down to the floor to one of the booths where one of the sell side firms would be, meaning like a Goldman Sachs or a Morgan. And then I would take the order ticket out to the broker, and the broker would execute that order. And then it would go in reverse, and then the trade would be sent back upstairs, and ultimately the customer would know what price they bought the stock at, and their execution and all the different details. I was what was called a specialist or a market maker down on the floor. At the end of my tenure, I was CEO of Kellogg Capital Markets. We made markets in 800 different stocks between the New York Stock Exchange stocks and the Amex stocks once they were that platform was bought by New York. As a specialist, there were basically four primary things that I did. The first thing I did was I'd go in the morning and I would be basically an auctioneer. So what I did was create a platform, or I would work within this platform where buyers and sellers would come together. And then I would be yelling out to folks what we had to do on the opening, before the opening, and things like that, and convey information to help them make decisions about the order flow they were representing. The second role that we had was acting as an agent. So when someone was so busy that they couldn't be in 10 places at the same time, they might choose to leave me their order. Let's say they had 5,000 shares of Disney to buy, but they had 500,000 shares of Cisco or whatever other stock it might be down on the floor, Apache Oil or whatnot, that they would rather spend their time there. So they would leave their order with me, and I would put their interest ahead of mine. I had to. That was a regulatory requirement. And I would represent them as an agent. And we used to get paid a commission for providing that service. The third thing was acting as a catalyst. And what do I mean by that? So when you traded certain stocks down on the floor, a lot of them had their own personality, and they had their own kind of following with different constituents in terms of the brokers that were typically involved in those stocks. So if I would come in the morning or anytime during the course of the day, and there was a buyer that I knew, let's say Dan was a buyer in a stock yesterday, and someone came in to sell that stock today, Dan used to wear a beeper, and I would hit his badge number up, and he would come in and he'd say, "Hey, what's going on?" And I'd say, "Listen, I've got a couple of sellers in the stock. You were a buyer yesterday. Why don't you see if you have any further interest?" So we would act in trying to bring together buyers and sellers to improve prices for the ultimate customers. And the last thing is, when supply and demand got out of whack, then we would stand in with our own capital to either help the stock make its move on the way up or make its move on the way down. And we would supply our capital on average about 15% of the time to help the movements in stocks. What I would say is the advent of electronic trading, in my mind, it was absolutely evolution. I mean, when I started on the floor, there were 5,000 different folks running around. When you go down there now, I don't think there's 500.
Yeah, maybe we can give a quick little picture of what it used to look like, because you see it on TV, you see people smiling, clapping, and whatever, and that's really
it's a TV studio now, right?
Exactly. But that was the amazing. It became a TV studio probably in the 90s and early 2000s, which was a brilliant marketing ploy by the NYSE. But when I arrived in 2001, there were 5 physical trading floors. So, imagine the NYSE building. There was a bridge across Exchange Place to something called the New Room. There was the Blue Room and the Extended Blue. They're very creative with the names. Very Extended Blue Room, the Main Room, and then the Garage, which I don't know why it was named that, but that was what it was called. And so each stock traded in one place only. So Charlie stood at a post representing 50, 60, whatever number of stocks it was. And if you wanted to trade one of Charlie's stocks, you had to go to Charlie. And so that was part of the reason why there were 5,000 people running around the floor. In fact, there was a line painted around the edge of the floor called the Blue Line. And God help you, if you weren't a member with business on the floor, you were not allowed to be inside the Blue Line. And so, here I was, a lowly regulatory employee, and I had my little regulatory badge, and I would, sort of gingerly step across the Blue Line, waiting to be plowed down by a broker who was running wherever it was he was running to. And probably 90% of the time it was a he. So just, the historical artifact there. But it was noisy, and people spoke in code. Charlie would be able to tell you the patter of how do you communicate a bid and an offer in like as few words as possible. Everything was done in lots of 100, so you just dropped the zeros. It was 1, 2, 3, 4, 100, 200, 300, 400. That was because when you're dealing with an oral communication, you want to say as little as possible. And then, so Charlie, I don't know if you want to fill in on how one communicated, because I think it's fun. And
well, I mean, it's think about going in and shopping for a car, right? When you go in, you don't first of all say, there's going to be a price on the car, and the price on the car is $35,000. So you don't walk in and write a check for $35,000. You'd walk in and you would bid at some price lower than that. And so typically on the floor, when I didn't know if someone was a buyer or seller, if they said, "I will pay you $25,000 for that car," when they use the word "for," I knew they were a buyer, right? And if the car seller would then, if the dealership would say, "We'll sell you the car at $35,000," if they use the word "at," I would know that they were a seller. So that language went on. And then there was also take them and sold, where, if you take something, you're a buyer. You took the car at $30,000 from the dealer, or the dealer could say sold to you at $25,000, right? So all that type of language was fun. But what's interesting to me is what's happening on the floor, and the technology that kind of replaced all those jobs. It was purely evolution, and it needed to happen because you could not keep up with the pace of the frenetic pace of order flow coming in and maintaining compliance with the rules of the exchange. So I, in some ways, really welcomed all of the technology. And what's happening now is exactly what was happening in the manual market. It's just being done electronically. That's the easiest way to think of it, I think.
And what about the hand signals?
We didn't really use
that was the whole thing, right? No,
we didn't really use hand signals.
There was one. There was a middle finger going up. I don't know what that was about, but
yeah, or whipping a sandwich at somebody or something.
Is that more of like a commodity pit thing?
That's more like a commodity pit thing. Yes.
Okay.
Yeah.
So, all right. I think all right. What about like, were there really advantages to size, like physical size? I mean, you hear all these stories about like bigger people would just do better in these situations. Is it true? Did it make a material difference?
I would say, I don't know if size was the most important thing. I would tell you that what was amazing to me about working down there was how quickly people could react and to things that were happening. When you think about it, there might be an order on a desk upstairs that's been shopped around for, a big seller looking for buyers, and the banks and everybody are talking to each other. And they talk about this large block of stock for sale, and they're trying to find, how would they not impact the market so much? How could they get this big sell order executed in a way that would, not be impactful to the market? And then ultimately they would come down to the floor and they would tell us, this trade is going up at this price. What do you want to do? And we'd have 10 seconds to make a decision as to, did I, as a market maker, want to participate and buy stock from that seller? Did I not want to do that and continue to make an aftermarket to support whether the stock went up and down, and use my capital for that purpose? But I would tell you that you had to be thick-skinned. It was not for the faint of heart. Nobody really cared that you were having a bad day or that you were losing money, right? When you were losing money as a market maker and you're trying to do your job and trying to make sure that the customers are happy. And one important thing to understand is we were rated by the brokers as to how well we did our job on a quarterly basis. And the reason that those ratings were important was, if I was someone who really tried to be engaging with all the brokers and I got great ratings, then that would go to the allocation committee. So when new stocks would come to the floor, we would then be able to go and interview for those stocks to expand the amount of companies that we made markets in, which made the firm more valuable. So there were a lot of checks and balances, not to say that there weren't some bad actors throughout the years down there, but for the folks that really, I think, it's like anything. It's like the one bad kid in the class, right? There's always going to be someone, but the vast majority of the folks who work down there were fighting day in and day out. To me, it reminded me of a rugby game, right? Someone could come into me with an order and we could bang heads as to how we were going to get that executed, or, what the guy was doing. But at the end of the day, we're out having a beer with the same guy. And to me, it reminded me an awful lot of playing rugby in college.
I just add, my most interesting thing about it was the whole "your word is your bond" thing. There's a lot of stuff that happened. Millions of dollars would trade hands without a piece of paper, and without lawyers, and without contracts, and without endless negotiations. It was, you're done, and then you were bound to that. And the whole system functioned largely on that trust. And when you're face to face with somebody, it's easy to maintain that trust. When you're sitting behind a computer screen, we see this on the internet with Godwin's law. It's easy for that kind of trust to break down pretty quickly. So.
Yeah. What was the hardest part of like regulating that or surveilling that environment, Dan?
So one of the biggest challenges, first of all, was getting up to speed on the language and being able to follow what was going on. I remember sitting in meetings where people would say, "Yeah, it's 5 for 10," and I'd look, I go, "I have no idea what the hell you just said." But once you got through that, so that was the first ramp up thing. But once you caught on, then I think the hardest part about the regulation was, because it was a manual trading environment, was figuring out what happened, and there wasn't the same kind of clear audit trail that there is today, obviously. And sort of the big innovation at the time was a keystroke log. So every time the specialist clerk would press a button on the keyboard, that would get logged somewhere. So if you were trying to recreate what would happen, you would be going through reams of paper trying to find the sequence of keystrokes that would tell you which, when the trade was, that was a challenge.
So
yeah,
do you think
actually, when you just wanted to add, when you really think about it, if you think about buying a house, right, and you think about inspections, and you think about, it's $1.5 million house, whatever the house is, and you're going through
Jennifer Daycare.
Sorry. And you think about lawyers being involved and the contracts that are involved and the closing and all of those different things. I think when I was there was approximately $40 billion changing hands on a daily basis on the floor of the exchange without any contracts, without anything other than Dan saying, I bought from you. I say to Dan, I sold to you. This is the price. This is the time. Here's my badge number. Here's your badge number. That's all we did all day long. And $40 billion a day would change hands just with that trust. And it was amazing. And it was amazingly accurate as well. I mean, there were errors at times, but for the most part, the trading assistants, the clerks, were absolutely unbelievable at doing their jobs. I mean, Lou Pastina said there were one of our partners in our consulting firm said that he did a study when John Thane came to the exchange after Grasso, and that there were 30 million keystrokes being hit a day on the floor. I mean, that just kind of shows you that the human ability to keep up with that type of, that kind of liquidity and that trading, it wasn't possible anymore. So we need technological help.
So what was it like when that technology started getting introduced? Like NASDAQ comes along, for example. What was it like on the floor? Was there a recognition that this is sort of a harbinger of things to come, and
I
the
wouldn't
world is
say
changing?
I wouldn't say personally that it was the NASDAQ. I would say it was more of the so when I started down on the floor, the NYSE had about 87% market share. What a lot of people don't seem to understand is even though their market share hovers somewhere around 20% today, during the middle of the day, it's much lower than that because you have to exclude the opening and closing kind of prints, right? Which for the primary market is a lot of the volume that takes place. So with the internalization of order flow and with, off exchange trading that kind of took place, it was a pretty precipitous drop in kind of the market share that we had from the early 2000s to 2010, I would say in particular. But again, that was kind of evolution and Reg NMS and competition for markets and all kinds of things like that I think added to that.
Yeah, there was a regulatory compromise that went on. There was a lot of, the rise of ECNs, the electronic communication networks, that eventually became the alternative trading systems that we know today. The regulation of those things, they are by all marks, they have all the hallmarks of an exchange. And so theoretically, they ought to be regulated by the SEC under Section 6 as a registered securities exchange, et cetera. But there was some pushback on that. So the compromise was that those networks became regulated under regulation ATS, which was a kind of exchange light. And if they crossed certain thresholds, then they would have to register as an exchange. And meantime, the exchanges got to retain some of the benefits of exclusivity and being able to set prices and things like that, and get fees rebated to them for market data because they were creating the pricing information that the ATSs were using. So the result of that compromise was that markets got faster and more diversified and more diffuse. And so, even if the traders didn't necessarily see it this way, I think that compromise was the beginning of the changeover that we see today. And the other point that I think is important to realize is what exchanges do today. They are factories for information. sort of at a very basic level. They provide information about what is a buyer willing to pay, what's to accept, and what's a seller willing to accept. And that pricing information goes out into the marketplace. That's why we call them lit markets. It's a visible lit price. The ATSs use that information and price between the bid and the offer, or they price in a way that is not transparent, which is why they're called dark markets. And so that compromise, I think, required the exchanges to advance themselves while they retained certain benefits. But that meant they had to get more technological, had to quicker. They couldn't continue to be manual markets.
Okay, so let's talk a bit about that. Yeah, so today there are 15 exchanges.
Correct.
You guys hope to be the 16th exchange. So you're starting a new stock exchange. What does that even mean? Why? I mean, what's the point of a stock exchange, and what do you hope to do by starting a new one? What's the market lacking right now?
Right. So first of all, there are 15 or 16 registered exchanges. 12 of them are owned by 3 companies. So when we say that there are 16 exchanges, there are really, it's like saying, Coke makes lots of different drinks, but they're all Coca-Cola products, right? There's the NYSE owns 5, NASDAQ owns 3, SIBO owns 4. My math might not be perfectly correct there, but there's concentration. And so there are a handful of what I'll call independent exchanges. And so we are aiming to be I think the 4th of those independent exchanges, maybe the 5th.
So we've got Investors Exchange, MEMX, LTSE, and MIX.
So we would aim to be the 5th of those. So why does one need another exchange? It's a fantastic question, and the innovations that have taken place in the world of stock exchanges over the last 40 years have virtually all been driven by faster trading and cheaper trading. Getting the latency of an order down to as close to 0 as possible within the laws of physics, and getting prices as low and close to 0 as possible. Sometimes to the detriment of the market. And I won't name names, but there are market participants who take advantage of the fact that they have size and scale, and they can push prices down in a way that may not necessarily work for everybody's benefit. And I know you guys have spent a lot of time thinking about and talking about that. And I might
clarify with in terms of fees. I would say innovation has been to both push fees down and also make them as complex as possible.
Fair enough. That I think if you read the pricing sheets of any of the exchanges, it would be hard to come to any other conclusion that they are complicated. In any event, so the place where there has not been innovation in the same way has been in helping companies to raise capital, which was originally the purpose of a market. Originally, you came to a public market in order to diversify your investor base, in order to raise additional capital for people who might not otherwise have contact with you, and to create a way for a larger number of investors to interact with you. So trading innovations, while certainly helpful, don't really go to the question of, am I effectively helping companies raise capital? And as one consequence of that, you've seen the number of publicly traded companies go down over the last 10 years, 15 years, significantly. And there are lots of reasons why that happens, some of which are exchanges doing, and some of which are things like Sarbanes-Oxley and other reforms that made it harder to be a public company. But certainly, I think our observation was there are places where exchanges could be doing more than they are, and we saw an opportunity in one of them. And so that's my pivot and transition to GIX specifically.
Let's do it.
Yeah. So what we observed as we were consulting with market participants was, when it came to sustainability, ESG generally, but sustainability specifically, there's a lack of information quality and a lack of trust between investors and the companies they're disclosing. We've been doing ESG, and before that, corporate social responsibility, and all that kind of thing, for like 20 or 30 years. Last year, a survey of investors by PwC found that 94% of them don't trust the disclosures they get from companies. If you think about it from an efficient market perspective, That is a colossal failure.
It's huge. Yeah. Well,
Because,
especially in the context of the U.S., right? Because the U.S. In the U.S. regulatory regime, we are a disclosure-based regime, right?
right.
I think this is important to understand because and many people actually don't seem to understand this because they're like, I've seen this a lot online. They say, well, the SEC approved this filing. It must be a high quality filing. And
Right.
that's a major distinction between a disclosure-based regime and what's called a merit-based regime, in which the gatekeepers, such as regulators and exchanges, approve filings because they are, good, not because they are an adequate disclosure. And that is the sort of the spirit of the US is, as long as companies disclose everything material, it is up to the market to determine the merits of the disclosure, not the regulators or the exchange, right?
Yeah, we in America hew to the idea of individualism and exceptionalism. The government shouldn't be picking winners or losers. So we have a system that is designed to let markets pick winners and losers. And the only thing the government does is make sure the game is fair, make sure that disclosures aren't fraudulent, make sure that the information is robust and complete. They do it better or worse depending on your view of government efficiency. But the ideal is the SEC and the exchanges will verify and validate that the information is complete. And it still may be a terrible idea, and it still may be an unprofitable idea, and the company may still go out of business, but investors will know they'll have adequate information. They can make that judgment for themselves, and they can vote with their dollars.
Right.
And if you go back in history, there used to be a time when we didn't really have financial reporting standards the way we do today, and companies could issue stock that was fraudulent. They could water down the stock. They could favor one group of investors who were insiders. They didn't have to disclose information. It was kind of chaos. And the NYSE, this was probably in the early 1900s, the NYSE looked at that and said, our reputation is on the line because we're trading companies that are fraudulent. So if you companies want to list your stock here, you want to be on the list of stocks that we trade, which, by the way, is why we call it being a listed company. You're on a physical list of stocks that we trade. Then you have to commit to providing certain information to investors so that they can find out for themselves whether or not it's a profitable company or not. Mm-hmm. And so the NYSE was the progenitor of many of the proto-corporate governance things that we see today and take for granted. And then in 1934, when the SEC was formed, they adopted or adapted many of those kind of principles to become the standards of corporate governance we have today. So now, fast forward to the early 21st century, we're talking about sustainability and information to investors, and there is nobody who is doing that same level of verifying and validating the information, saying to companies, if you want to, be taken seriously, you have to provide certain information to investors in a standardized format, in a way that's understandable, in a way that's consistent. So we decided that there was an opportunity there, and that's what we're doing.
Well, I would just add that when we looked at this, first of all, we are focused on the E of ESG. We are not focused on the S, although we believe that companies that are performing well on the E are probably doing well with the S anyway. But the S is a bit more of a political football. I don't know anybody who doesn't care about the environment, to be perfectly honest. So we chose to focus on the E. When we looked at the ESG landscape, there are 600 reporting frameworks globally now, even though there are many that are kind of seen as the leaders. Most of them are backward looking. It's important to try to disaggregate the E plus S plus G. There's selective reporting that goes on. You can selectively disclose things you want to disclose. Some things that you don't want to show, you don't have to show. And they really don't tell you where a company is going and how they plan on getting there. And so when we looked at that, we said to ourselves, what if we were to use capital markets mechanisms to help with that problem, so that investors, that 94% that Dan spoke about earlier, could feel as if they're getting trustworthy information from companies to help them make decisions of who they want to support and who they don't. And this is becoming more and more critical to the younger generations that want to support companies that are doing the right thing. They want to work for companies that are doing the right thing, invest in them, buy from them. There's a massive amount of capital that is earmarked for investments in the space. Reuters and Bloomberg both say that by 2030, there'll be $50 trillion looking for homes in this area. What we're trying to do is to marry that capital to companies who are really willing to walk the talk, instead of just greenwashing and saying, well, you know, we're going to do this and we're going to do this. And guess what? By 2050, we're going to be carbon neutral. That's 3 CEOs from now, right? So anyone can say anything they want currently, and they're not going to have to answer to it in 2050. So what we're saying is, if you lay out your plan in a trustworthy way, and you allow investors to look at that information to solve for the agency problem of not having to go to company to company to company to ask them, but have it done under an exchange banner where there's accountability and enforceability. Those are things that don't really exist in the ESG framework today. And we're trying to introduce that so that companies that are really doing the hard work to be good corporate citizens can attract some of the capital that's earmarked for investments in the space to help them to get to where they're trying to be in 2050.
So let's talk about, I mean, isn't that the crux of all of this, accountability and enforceability? Because today, a company can get up there and they can essentially say almost anything they want, right? And there is no real framework for repercussions if they fail to achieve what they're saying or fail to try, right? Isn't that a fundamental part of the problem?
Think of it this way, Dave. When a company goes to list at the New York Stock Exchange, why do they want to be there, and why is it important, right? So first of all, yes, everybody wants to be on the first tee of their golf course and say, I rang the bell and I have a company listed on the NYSE or the NASDAQ, right? But when a company meets those listing requirements, the NYSE doesn't say the company's going to be profitable or not profitable. They don't say that it's a good company or a bad company. They say you can trust the data that is being provided to you by the exchange, by these companies, and you can use that data to make investment decisions. And what we are doing the exact same thing on the sustainability front. We are not stamping that a company is green. We are saying that this company has met these listing standards, which Dan can get into in a second, what we're asking companies to do to show that they're credibly committed to what they're saying publicly. And to us, that will help capital flow to those companies.
And I think to Charlie's point, it's accountability, and then there's even a more pressing problem, which is that the companies don't even have to disclose if they don't want to, or they can disclose selectively. So some of it is that I can't even guarantee the quality of the information that I'm getting, let alone accountability once the information is out there. What an exchange listing brings to the party is that a listing is a contract between the company and the exchange that says the company will do certain things on the governance front. And if the company doesn't do those things, then the exchange can threaten them with delisting and eventually delist them. And why that's important is that if a company decides not to report on something next year because they don't like the numbers, nobody knows it. If they don't do that in the environment where they're listed, they get a notice from the exchange saying that you were required to report something, you didn't report it. Well, guess what? That delisting advisory letter is a publicly reportable event. It goes into Edgar. The company has to file an 8K. So now every news service that scrapes Edgar looking for information now publishes something that says XYZ got a delisting advisory notice from the exchange. If they don't correct it and they get delisted, there's another 8K that gets filed and a Form 25 that gets filed, which again gets picked up by all the news services. So suddenly something that was, I can get away with doing this quietly, maybe issue a press release that nobody pays any attention to, suddenly becomes something that gets reported on Yahoo News and Yahoo Finance and Google News and wherever else is scraping those filings. So just by listing, you've created a form of public accountability. And then on top of that, the things that we're asking the companies to do are things that will enhance transparency for investors and therefore let investors make informed investment decisions. So, for example, right now, if I told you that Charlie's going to lose 50 pounds, right? And I say, what's the strategy? Charlie says, I'm going to eat cheeseburgers, and I'm going to eat, and drink milkshakes all day. I think Charlie's not serious about his goal. But if Charlie says, I got a dietitian and I'm working with a trainer and I'm doing this and I'm doing that, and tells me all the things that he's doing, now I can evaluate whether or not to bet on the ultimate goal. And that's what we're asking companies to do is to commit to, here's a goal and here's the infrastructure behind that goal that's more than cheeseburgers and milkshakes. It's at the board level. Does the board actually have a commitment to real oversight? And by that, I mean that it's a part of the regular board agenda through a committee that's dedicated to this, that has sustainability as one of its focus. Is there communication between the board and management on sustainability? It's not just, item number 17 on the CEO's agenda for an hour-long meeting, but there's a sustainability officer who's assigned to dotted line report to the board on sustainability. Then at the management level, it's the disclosure to investors is not only is this our 2050 goal, but here's what we're going to do in 2030, 2035, 2040. And you can measure us as to whether or not we're getting to those waypoints. And if we don't make the first waypoint, the chance we're going to make the 2050 goal goes down. If we don't make the second waypoint, the chance that we're going to make the 2050 goal goes down even more. And so it's asking companies to disclose, what should I as an investor be measuring you on? And how are you going to get there? And then the third leg of that stool is the actual data that the company provides. But instead of picayune, technical, uncontextual data, now I have something to measure it against. If you said, I reduced my carbon by 200 tons last year, that doesn't mean anything. But you say, my goal was to reduce my carbon by 1 million tons over the course of 5 years. And last year I reduced it by 200 tons. You go, 200 is a lot smaller than 1 million, right? Right. It puts some context on it. And then to make sure that that data isn't selective and isn't like cherry picked, we're asking companies to do what's called limited assurance, which is a third party who looks at the controls that generate the data and say that those controls are sound controls and they don't raise any reason to believe that the information is materially misleading.
A CEO certification.
Right. Well, before you get to the certification, but the end of when you certify or audit data, you can either get a limited assurance or a reasonable assurance. Limited just means I've looked at the machinery that produces the numbers, and reasonable assurance is I've looked at the stuff coming out of the machine and made sure that the stuff is accurate. We're asking for the lower one for now because we think that that's a more achievable goal and it still benefits investors. Then, as Charlie was talking about, at the end of all of this, you have the CEO certifying the companies in compliance with those listing rules. And I will tell you, and you probably know this too, Dave, as the CEO of a company, when somebody puts something in front of me and says, please sign this and submit it to a regulator, I go,
you're going to care.
Yeah, I care. And can you show me why that's true? That's a very important differentiator, because a press release, fine, it's a press release. Nobody pays attention to those. But when I sign my name to something that has regulatory jeopardy attached to it, oh boy, So we hope that combination of things, that constellation creates accountability and trust, and that investors can rely on it. And then the last piece that I'll give you is that I don't have the resources of State Street or Vanguard or BlackRock. So they have hundreds of people who are looking at companies' disclosures, looking at environmental information, sustainable information, coming up with an opinion. But I don't have the time or the resources to do that. So a GIX listing becomes a proxy for average investors. Say this company has made a regulatory commitment that it's going to be straightforward with us. It's going to try to do the right thing. I can rely on that as a shorthand. I can go look for the information. I can go read what they say, but as a starting point, I know where to look. I know who are the quote unquote good guys to start with.
And I can tell you that over the past 18 months now, and we started this probably 3.5 years ago, but we have reached out to probably, I would say we've reached out to 840 public companies. We have 250 that are very interested in what we're doing. I spend a lot of time on calls with these companies. One very important distinction is that we are not asking anyone to leave the New York Stock Exchange or the NASDAQ to list on our exchange as their primary market. That would be a fool's errand. So this would be a dual listing where a company could stay with their primary listing, but dual list on this exchange to get credit for what they're doing on the sustainability side of their business. And I can tell you that companies are extremely frustrated with finding ways to separate themselves from the companies that are greenwashing. And so our listing fees would be based on the market cap of the company. So we're trying to make it attractive for all sizes of companies to join. We would also, we are also set up as a public benefit corporation, and we think we need to be part of the solution. So we'd be the first exchange in the US, I believe, that we're going to be giving 1% of our revenues back to the environment through NGOs and other organizations, because we think it's super important for us to do that. But these companies are looking for ways to stand out from their peers. And I think, honestly, a lot of them want to raise the flag and say, we want credit for what we're doing. We're spending an awful lot of money reporting to all these different frameworks. This is a way to turn what is a cost center into an opportunity to attract capital.
And I think that's probably one of the more interesting parts of your approach, and people may not realize this, but the exchange listings space is one in which other firms have tried several times now and failed to break this duopoly, and to be, at least in the US, NASDAQ was the last one to actually make a change in the listing space.
Whoop.
Looks like we lost our host. Uh-oh.
Did I lose you guys?
Oh, no, you're there. You're back.
Okay. Yep. And to actually do something, that was quite a while ago. And we have seen the CBOE try to compete. We have seen IEX try to compete, and neither has been able to. And when you really, I think, pick it apart, one of the main reasons, and I was part of an effort in Canada, Equitas, which became the NEO Exchange, which is now owned by the CBOE, and it was the first exchange to really come in, I would say, in North America in recent memory, and actually have success pulling listings away from an incumbent. In this situation, it was the TMX, and that was again a primary listing. What you guys are trying to do is I think pretty unique with this idea of a secondary listing, which I think companies are used to doing that across geographies, right? Mm-hmm. You can have a primary listing in Canada, secondary on the NASDAQ, or across Europe, other markets. Right, right, exactly. But would this be the first time within the US that there's sort of this primary and secondary listing offering?
No and yes. So NASDAQ, one of NASDAQ's strategies in 2003 or 2004, when the NYSE finally repealed its Rule 390, which prevented members from trading on other exchanges, was to NASDAQ offered dual listings, a try to buy kind of situation, hoping that they would, companies would come to them and see how wonderful NASDAQ was and eventually leave home and come back, leave the NYSE. And at the time, interestingly, Bob Greifeld, who was the CEO of NASDAQ, talked about, the enhanced quality of governance standards on NASDAQ, and that companies dual listing on NASDAQ were doing so because they wanted to demonstrate their commitment to, governance quality, which, so I will admit to shamelessly stealing that. But interestingly, you mentioned Equitas, and I was actually going to mention that what distinguished Equitas and what distinguishes us, I think, from the other attempts is trying to fill a niche that's underserved. IEX tried, and I think their appeal was, we're going to offer you free listings. And there were other reasons why it was a worthwhile idea, but it turned out that pricing wasn't the draw that some people thought it would be. And Bats tried it, and had an unfortunate meltdown of its own IPO on its own exchange. And I think that undermined confidence that people would be willing to trade there. And now everybody's frozen. Am I? Hopefully.
Oh no. Can you hear me?
Yeah, we can hear you. Yeah.
Oh geez.
Yeah.
I'm having a video issue.
Yeah,
of course.
We know what your pretty face looks like. Don't worry. So yeah, and I think
we'll keep going.
Just imagine a handsome bearded guy with headphones. I think
Graying, yeah.
The problem was there was no real differentiator, right? That's where the problem really, I think, the other exchanges that tried the listing route. First of all, a lot of them tried the primary listing route. That you're never going to pull anybody away from New York or NASDAQ to list on a fledgling exchange. So we immediately started with the dual listing route, right?
I won't say never. I'll say it would be more of a challenge and a very uphill battle.
Yeah, but to us, the company is getting something different from GIX than they would have gotten from just listing on another exchange as a trading venue. It doesn't really, I mean, listen, I don't think I would do it. What would be the reason, right? You're on the big board or you're on NASDAQ and you know, you're represented well. The problem is these companies are not getting the credit that they should be getting for what they're doing on the sustainability front. And investors are clamoring to figure out who is really doing a terrific job in this area. And we have tons of data that shows that companies that perform well in this area outperform their peers. And the London Stock Exchange created something called the Green Economy Mark. If 50% or more of your revenues come from sustainable sources, you can apply to get that marker. Since 2019, they've had about 120 companies get there, and they've all outperformed and outraised their peers. So to us, you know, people say ESG is dying. It's not dying at all. Every company that we talk to tells us, regardless of what goes on in DC, they're continuing down this road because it's vitally important. It's vitally important to their stakeholders. So, you know, and the other interesting thing when I talk to the companies is I say to them, why are you doing all this? What's the reason? Why are you spending all this money? Why are you reporting to 3 different frameworks? Why bother?
Right.
If it's all up in smoke and you're just burning these dollars, why do it at all? And you know, the answer is that it's not dying whatsoever. I mean, I remember Larry Fink being hit by somebody in Davos saying, "Oh, you lost all billions of dollars. You lost $5 billion from Texas or wherever it might have been. That, you know, because of your ESG stance and blah, blah, blah." And he said, yeah, you want to talk about that story, but not the story that I took in $100 billion of investments for people who are looking for answers, right? So the one story doesn't get the play time that the other gets. So
I also think,
yeah,
Dave,
and I think that's really important, right? It you know, this issue has gotten strangely and unfortunately political, but when it comes down to it, this is a story about private markets, right?
Totally.
This is a story about a market-based economy where there is demand, significant demand for something, with people, you know, investors want something, and there's no good solution today for companies to respond to this private demand for something. And you guys are stepping in and creating that.
I think it's interesting when you say there's an investor demand. I think that glosses over an important point, which is, and I know the audience that Irvin Finance, you know, attracts. That audience, the retail investor audience, is way ahead of the big 3 when it comes to sustainability. I think, you know, statistically, if you look at all the different surveys, consumers are willing to pay more for sustainable products. Employees, particularly millennials and Gen Z, will choose companies based on their credibility on various ESG factors. And increasingly, younger investors and now even older investors are coalescing around the idea that a 1 to 5% discount on short-term ROI is acceptable if it means that the company can achieve long-term sustainability goals, that the investors are willing to trade the short-term return for the longer-term value creation. That's new. And I think that signal sometimes gets lost in the professional institutional market noise, particularly since structurally retail investors have a difficult time getting to public markets, just because of the way order flow works. And I think that the big three, Larry Fink was very vocal about ESG and then suddenly was very unvocal about ESG, and became an investor in the Texas Stock Exchange. And other big three and large institutions have various stances that may or may not reflect that growing investor sentiment in favor of sustainability. And so I think having a public market where a company can show its sustainability bona fides and the market can put value on that is another transformative way of thinking about this, because it's no longer in the shadows. It actually comes out into the light.
So let's we're getting close to wrapping up, but I'm curious for you guys to explain, like, what is, you want to create a new stock exchange? What's the process for doing that? Where are you at in it? Where
the first comment is we wouldn't recommend it. So
yeah, it's not the faint of heart.
Why would anyone do such a thing?
So you do such a thing because I think that it adds an important conversation. So all the reasons we've talked about up to now are the why. The how is that you have to go through a filing process with the SEC to get an exchange license. And you file, so the very first form that the SEC ever produced when it was formed in 1934 was to register stock exchanges. So the form is called a Form 1. It is the primal document, the first one. And it is a document that lays out what is the corporate governance structure of the exchange itself, and what are the rules of the exchange, and all kinds of technical details about the exchange, including a description of the listings rules, which we had to write a long brief about. You file that with the SEC. We went through several rounds of negotiation with them before you file. It's kind of the way when you do an S1 filing, you never just publish it. You talk to the SEC several times, then they tell you that it's approved for filing, and then you file it. So we went through the same kind of process. So they published our application for public comment back in July. And we had the comment period lasted through September 6th. We received 30 positive comment letters and 0 negative letters. One of them came from the esteemed company of Irvin Finance, whoever they are. But we also had letters from Ceres, which is a large sustainability-focused organization, the Nature Conservancy, a group called As You Sow, which is an investor protection organization. And interestingly, we had one from the United Farm Workers, who told us that on behalf of 1.5 million farm workers, they are in favor of this, which I felt very good about. My wife said, "Where are they all going to sit?" They're standing in
the
front
floor of the exchange, of course, right?
Exactly. 1.5 million people on the floor. But so we've had a widespread set of support. So what happens now is that the SEC goes away and thinks about it, and they have told us that due to administrative workload and the incoming imminent elections, they're going to extend the approval deadline to probably January, which was not unexpected. There's been very rare that you see them act on the last day. If there's an extension available, because with all due respect to the SEC, they are under a tremendous amount of pressure right now to get a lot of things done between now and say January. So I will never disparage my regulator, and I would just say that they've asked us for an extension, and we're okay with that. Eventually, though, the goal is to get an approval order that allows us to go forward and build the exchange. And once you do that, then there's probably a 6-month period where we're doing all of the technical things one has to do to launch an exchange, including getting your matching engine up and running, getting connectivity, doing industry-wide testing so you don't blow things up on the first day, and all of that kinds of stuff. And that probably takes 4 to 6 months of work that is technical in nature.
Dave, one of the things I would mention, and you've hit on it a couple of times, we have obviously engaged the Hill. We've been down to DC. We have, we've done a lot of outreach. What's interesting about what we are doing is it is an open marketplace, right? This is a free market solution. And that resonates with both sides of the aisle. Instead of having the government mandate what is disclosed, what isn't, this is voluntary for companies. It is not mandated that companies do it. If a company sees a benefit in listing on this exchange to get credit for the sustainability efforts, they can do it, but it's not forced on them. So I think it's one of those rare occasions when both sides of the aisle can kind of get their heads around what we're trying to do, and then provide quality information, trusted information to investors, and then let markets do what they do. Yeah. Then put it in the hands of the markets, and markets are highly efficient, as you know. And people will vote with their dollars, and they'll vote to support companies, and they'll vote to punish companies. And
can I put a plug in and a poll question to your audience, which is one of the things we've talked about is how do you get retail order flow to the exchange? And I would love at some point to hear the thoughts of people in this audience about the idea of a directed order, a green impact button. So you go into your broker's OMS, you push, say, I'd like to trade the stock, and I'd like to trade route to start at the Green Impact Exchange because I'm making a statement about sustainability. That's something we're thinking about as a potential way of shifting the dynamic in the market. So I just put that out there for your audience to think about.
But we will obviously be honoring best execution. So if we didn't have the best price, we would be routing that order to the exchange that does.
To the exchange, right? So I think there's a side of this that is to say, I want to route that order to the Green Impact Exchange, but I especially want to route that order to a lit market, and I don't want my order executed off exchange. And from a sort of let's even call it a sustainability perspective, like how are markets sustainable when we're getting close to half of all trading not executing on lit markets, not contributing to any type of pre-trade price discovery? And I know that the people I talk to and hear from, they want their orders to be part of that price discovery process.
Well, we would like to be able to, if we can see the demand, we would be, actively interested in creating that venue and that pathway. Because we think that it's part of the problem is that if you have a desire and you can't communicate it to the market doesn't hear you, they don't pay attention to it. And we would like to give voice to that desire because we think that that's an important part of a free and efficient market. An efficient market takes into account all investor influences, so just something to tease the audience with a little bit.
Sorry, I don't know what's going on. I cut out there.
You're just so wowed by what we're saying. So I don't know where you've done it again.
All right, we're gonna have to. Well, we're at the hour anyway, so we're gonna cut it off with all these technical difficulties. I don't know what's going on today. It must be something along the border. Yeah, man, it must be the hurricane. Milton screwing everything up. Always Milton. But no, thanks, guys. Honestly. Yeah. Honestly, if you're in Florida and you're listening to this, you're in an evacuation zone. Please heed those warnings. This sounds serious. I have friends down there who are evacuating, and this is no joke. And so, but to everyone else, thanks for listening. I think this was a fascinating conversation. We got some history, we got some governance, we got some environmentalism, and
that's a provocative stuff to think about.
Yeah, for real. And anyone who has thoughts on this, let us know. Drop those in the comments on YouTube. Hop onto Irvin.finance and make a post or a comment. After we'll post this up there too. And thanks for joining us for Let's Talk Markets. Thanks, Dan and Charlie. Really appreciate you guys and what you're doing.
Thanks.
It's an honor to be here, and we appreciate the opportunity.
Thanks so much.
Awesome.
Bye, guys.
All right. Bye. Thanks, everyone.